why don't we just kind of get started? I know a lot of you guys, some of the older AEs probably are aware of who I am. Some of the newer AEs who have just joined, who have been on these calls, you haven't seen me before. So I might as well introduce myself. I used to host these calls way back when, probably 2 years ago. But have just been not really participating on that side for a while. My role at Acquira, I've been with Acquira since 2021. My role with Acquira now, as it stands, is I handle a lot of the what we call transaction advisory services work, which is really kind of the post-LOI due diligence analytics, help the QOE, review of the QOE, business plans, all that kind of stuff. Background, I'm a former investment banker, so I have a lot of transactional experience from that side of the table. Been doing something in this space now for probably 15 years or so. I do own a manufacturing company outside of Acquira. So got that going on, as well as doing what I do with Acquira to teenage kids, both in sports. So I spend a lot of time traveling with them for their various sports. And yeah, other than that, pretty much just a normal person, I guess. She's in. Brittany's here. Brittany, are you here?
I'm here. How are you?
Good. How are you? It's been a long time.
I know, it's been forever. When they told me it was you, I was like, oh yay, I'm so excited. And it has been like 2 years, because I met you on like my very first one that I did of these, and it was like 2-ish years ago. So yeah, no, sorry. When they sent me the link, it was not the right one. So I'm like, I'll talk to myself. I do it all the time. But I think you guys would rather, I mean, I prefer an audience, but whichever.
Yeah. Yeah, I know. I was just telling the folks that I haven't actually, you were probably one of the last calls that I did before I moved on into another role within the firm. But it's been quite a while. I'm glad we get a chance to chat again, and
yes,
and we can definitely I don't know, last time we did this, I think you just had a slideshow that we just kind of talked through it as you presented. I don't know if you're going to do the same thing.
Yeah, so Doug had mentioned, so hi everybody. If you don't know me, I'm Brittany. I think the last time I presented with this group was like in November of last year. So since there's a new crop, Doug had asked me to do the add backs and sellers discretionary earnings. So we got a presentation of like slideshow. It'll take like maybe 20 minutes to go through to kind of help you guys understand the differences between the two, because an add back and seller's discretionary earning, like the terminology kind of gets interchanged. So kind of give you guys the differentiation between those, understanding inventory and then other assets, because those are the questions that we get the most. Information for you guys, and we'll leave plenty of time for like Q&A, because this discussion you guys bring is just fantastic. I love it.
Well, great. So that being said, are you familiar with how to present on Google?
I think I do. Let's see. We're going to figure this out together. Okay, I'm going to do my entire screen of screen one. So we're going to share that, but I think you guys see yourselves. So let me pull the PowerPoint up and do this, and then switch that. And can you guys see the cover page with some very nice succulents on it?
Yes.
All right. All right, so I'm going to tell you guys right now, the jokes might not be good, but there will be a plethora. So if that one doesn't laugh, that's pretty much as good as it gets. So I remember one time I had a peanut butter and jelly joke, and one that it failed miserably. I'm like, okay, that's as good as they get. So little bit about me. I am a certified valuation analyst. I'm an owner here at Green Appraisal. In addition to being a CVA, I am a certified financial data analyst. I'm a business analyst. It's actually what my degree is in. I'm actually an instructor for the Texas Association of Business Brokers. So we are only going to spend about an hour together. The business brokers and TAB get me for 4 hours talking about valuation. So yeah, I like to chat about this kind of thing. In my free time, I am the founder or co-founder or president, and I'm also the chairperson of Clear Lake Ladies Night Out. It's a nonprofit organization here in my hometown of Houston, as well as I was just recently named the co-chair of Small Business Committee for Bay Area Houston Economic Partnership. So all of this should tell you that I know a thing or two, and I also don't stop or sleep. So moving on to what we are going to chat about today. So first up, we're going to talk about add backs. In there, we're going to talk about seller's discretionary earnings as well. The role of inventory in a business valuation. How do we evaluate other assets, and then adjustments and how it can impact the valuation. So first up, add backs. So an add back is an expense that is not going to be included in the future P&Ls for the company. So for you, as we're looking through, this is a valuation, what are those things that we're going to throw back in that you would not incur yourself in the normal operations of the business? So why does this even matter? Why do add backs matter? And why is there so much discussion around them? Is because the add backs normalize the earnings and provides a clearer picture of the cash flow for the company. Now, there's also kind of a brawl sometimes over what a seller would determine is an add back, what the buyer determines is an add back, and even what the bank for SBA loan purposes will consider an add back. So this is to kind of help clear up some of that confusion, hopefully. So some of the common add backs that we see are non-reoccurring expenses, so lawsuit settlements, one-time equipment purchases. So if you are going into a business, so like Rich with his manufacturing company, if he's going to purchase one piece of equipment like a forklift, it's not a reoccurring expense. He's not going to buy a forklift every 12 months. So that's going to be an add back for that one-time purchase. Now, if there is a reoccurring like inventory in that manufacturing facility, that would not be. Owner specific expenses, so personal travel, car leases, salaries being excessive. So we would actually come in and adjust an owner's salary per what industry standard tells us. So if the seller can draw a $150,000, $200,000 payroll off of the company, that's all good and great, but when it comes down to us doing a valuation, we're actually going to research what does industry standard tell us. So if industry tells us it's closer to 120,000, then we would actually make that adjustment to add back the difference between those two things. Non-cash expenses like depreciation or amortization, and any unnecessary or redundant expenses like unused subscriptions. So a little bit of a funny story, someone I was talking to about an hour ago on the phone. I have a colleague over in Atlanta, and we were talking, he's a business coach, and he was telling me about this client that he has that we were talking about his CRM and just how he just doesn't use it and this, that, and the other. So technically for some companies, they may have a CRM that they're using, you know, hopefully it's not as expensive as like a HubSpot or something like that to where they're paying a bunch of dollars and not using it. But it could be as simple as like a $10 or $15 unused subscription. That would be an add back. So whenever you're going in and taking a look at expenses, and this is what we do as well, going through that due diligence process, is we want to look at the expenses and be like, okay, are you utilizing this? Is this being used? Is this here? Okay, this is a reoccurring because we see that it's the same every year. But do you utilize it? If you're not, or if it's something that you as the buyer would not utilize because you would utilize a different system or software, it's built into a software system that you already have, so you wouldn't need it, that would technically be an add back. So it just led to an interesting story about laziness in CRMs. So, so what to keep in mind about add backs? So are the add backs documented? Can that documentation be provided? And finally, based on that documentation, are they justifiable? So for instance, we had an add back once for a vehicle that was purchased for the owner's wife. He couldn't figure out why the expenses had increased, and he forgot he bought his wife a Mercedes. So was the add back documented? Yes. Could the documentation be provided? Yes. Was the add back justifiable? Also, yes. because of the fact that the wife's Mercedes is not a company car. So the company paid for the car, but it's used for personal purposes. So it would be considered an add back. So as you're having this discussion with the seller, and they're giving you a list, like in their prospectus, of all the things that they added back, ask for the receipts, right? Of why was this done? What was their thought process on it, or what have you? Because just because the seller has added it back does not mean that as the evaluator or the bank or whomever, or even you in your assessment of if you're going to purchase, that it would also need to be added in as an add back. So now, we just spent about maybe 10 minutes talking about add backs. So I have a little quiz for you guys, okay? So the first question, and you guys can come off mute. I can't see the chat, unfortunately. So Rich, if there's questions, let me know. You know me, I'm happy to answer those as we go. But if you guys want to hop off mute and give the answers as we go, we can do that. So the first question is the owner's compensation of $100,000 a year an add back?
Maybe it's on energy standard.
Boom. Gold star. I love it. Thank you guys for listening. It makes me feel special. A one-time legal settlement paid by the business. Is that an add back?
Yes,
Why?
because it's not an ongoing expense for the business. It was a one-time.
Exactly. It is one time. You guys listen, I'm so excited. All right. So, Rach, I hear you laughing.
Is this for CPE? Because they tend to do this stuff for CPE. They make you answer questions in the middle of the CPE to make sure that you didn't even leave. And
Yeah, exactly. Yes. I have been through enough CPE myself. I know how to keep you guys entertained. I do not tap dance and I don't sing. This is as good as it gets. Okay. All right. So monthly rent for the business location, is it an add back or not?
No.
Okay, you're correct. But the rent could be adjusted. If the owner owns the building and they've been paying themselves an extraordinary rent, it's similar to the compensation of the owner. We would actually do an adjustment to reflect the industry standard for the rent. So yes, it is, you're correct. No, it's not an add back, but it could be adjusted. So keep that in the back of your mind as you guys go through rent. If you see a rent payment and it seems kind of high, my first question is always, does the owner own the building? And if it is extraordinarily low, my question is always, does the owner own the building? Because if they've been artificially lowering their rent so that they can have a better net income at the end of the day, we would actually have to adjust the rent to reflect industry standard. So again, a reflection of the actual cash flow of the business. So next question, owner's personal car payment that is covered by the business.
Come on, people.
Come on, y'all.
Yeah.
I'm gonna pick on Rich.
It's an add back.
Yes, it is an add back because it is a personal car payment. Because you as the buyer would not necessarily make that payment on that vehicle. You wouldn't necessarily have the business make the car payment on your car. Next up, wages paid to employees that are not the owner.
No.
No.
All right,
There you go, Blake.
there we go. I like it. That was a good sturdy no, it's not. I like it. All right, so the family vacation that was booked through the business as a conference expense.
Yes,
All right, why?
because that is not a reoccurring expense that you would have to undertake. As a
I
business.
love it when you guys listen. Yes, very good. And finally, last question, I promise. And if we get this one right, we pass. We got 100% gold stars for everybody. A business loan payment.
No.
Depends.
I think I heard somebody say no. I heard it depends. Do we have a tiebreaker?
No.
I'd say no.
No. The no's have it. I'm curious. The person who said it depends. Why did you say it depends?
The life of the loan and where it is by the time the person purchase it.
Okay. I see your thought process, but technically, since it's a business, it's pertaining to the business is making a loan repayment, it would not be an add back, because unless you are doing an asset sale, that liability is going to carry forward with the business. So it could be something you would carry, or if you're going to get a loan yourself, the business would do a loan repayment.
Makes
So,
sense. Thank you.
yeah. So, but still, hey, we got 8 out of 8 gold stars for everybody. I'm so proud. I have done my job. So I'm going to go get a pina colada and I'll see you guys later.
All right. So
Final
Luke,
thought.
to
Yes.
all the AI assistants here on the chat,
Uh-huh.
I did find a question from Luther who asked,
Luther.
yeah, it was about more or less pertaining to when you indicated that the owner's salary, if it was $150,000, you would
Yes.
add it back and it would be adjusted.
Yes.
His question was, well, what if the buyer wants a similar salary to the seller, even if it is above an industry standard?
So, okay, good, Luther, solid question. Thank you so much. So if you're going to match the owner's salary for due diligence purposes, you would not change it. Okay. So for due diligence, we would leave it there if that's what you're going to do. If we're in a certified valuation for SBA loan purposes, because you're needing to go get that loan and the bank has said, okay, we need to do a valuation, we would do an adjustment to industry standard. Okay. So it depends on the purpose on if we would do that, but for due diligence, we could leave it. For certified purposes for the bank, we would adjust.
Another way to think about this, Luther, is for your forecast moving forward, it would be valid to leave it if that's what you're planning on paying yourself, because you want to be able to assess the cash flow that the business is going to generate after you buy the business. So
yes, precisely. All right, cool. So let's move on to inventory. So exciting. So inventory, not everybody here would necessarily do an inventory, but I know if you're going into home-based businesses, manufacturing, things like that, inventory is going to be key, right? And if anybody's here that heard me in November and you think, oh, well, this is the same thing, we actually have a new component to inventory, so stick around, I promise, there's new things. So inventory is a working asset. So it could be a raw material, it could be finished goods, it could be supplies. So in the construction space, your raw material could be your wood, your siding, your paint, whatever. The finished goods would be the lighting or the appliance, something like that. Now, hopefully you're not carrying appliances in your inventory space, but there you go. And then supplies, like, you know, your hammer, your nails, your like, all of those things. Unfortunately, I had to go through reconstruction last year, and I understand construction so much more as from this side of the fence, and I don't like it. Now, how do we treat it? Okay. Typically, inventory is going to be excluded from your EBITDA. And for anybody who has never heard of EBITDA, doesn't know what it stands for, and someone says that, you're like, oh yeah, EBITDA, yeah, sure. You're not sure what all those letters stand for. It's earnings before interest, taxes, depreciation, amortization. Not that it makes any more sense after you know what everything stands for, but there you go. You learned something today. But the inventory is going to be part of the total purchase price, okay? So let's kind of dive in a little bit deeper. So there are certain key considerations you're going to take into for inventory. Okay, so the valuation methods. So you could be first in, first out. It could be last in, first out, or weighted average. So for example, I have a deal that I am pending over in Beaumont, which is a town that's probably 2.5 hours toward west of me. No, east of me, towards Florida. Sorry guys, left, right, east, west, it doesn't jive for me. But so I have a gig over here that is a daughter-in-law buying the business from the father-in-law for the cost of the inventory. So the book of business, all of that, they're just saying that's good. He just wants to get paid for the inventory that's in the business. So in the conversations with them, this is something we literally had to find out is, are they operating under a first in, first out, or last in, first out? Or are we going off of a weighted average? Now, typically you're going to decide these. Sometimes the last time they took an inventory can determine it. That's actually how we're determining it here. We're doing a weighted average because it just kind of goes on the shelf and then it leaves. They don't necessarily circulate it unless it's a food related item. Okay. So then it gets circulated. So whenever you're looking at valuation, there's inventory, those three ways to look at it. So it's going to come through, like how you value it's going to come through the conversation with the owner of when was the last time they took an inventory. this next piece, which is the condition. Is it obsolete? Is it slow moving? And we're actually I'm gonna show you guys the new piece is the ratio on how to calculate if it's slow or is it a fast moving, as well as its seasonality. So in this particular company, it is a mailbox place that has a boutique in the front where you can buy like gifts and like tchotchkes and stuff. So they have a lot of seasonal items because, you know, we just finished up with St. Patrick's Day, but we have Easter coming up. And if you want to send grandma something, you know, there's a nice little Easter card or a, you know, thing to hang on our wall, whatever it is. So those kind of things also has to have some kind of timing with the inventory levels. So, you know, if you notice, like whenever Christmas is over, it seems like Valentine's Day goes up in January and so on and so forth, and people like complain about it. But quite honestly, it's actually an inventory control. So it's not just sitting back there because they've already paid out the money for it. So they're needing to get that cash back. So it's not just sitting there. So whenever you see high turnovers on seasonality items, that's why. So I'm sorry, go ahead.
I'm sorry. I know I wanted you to get through your.
No, you're good. Question, answer, hopefully.
So I think this is all related to sellable inventory, right?
Correct.
Okay, because yeah, I think sometimes with some of these service businesses, some of these owners will throw some line item on the balance sheet for inventory, and it's nothing more than like, you know, maybe a pipe to help fix a, you know, an HVAC system or whatever. It's not necessarily sellable to the customer, but that's just where they kind of done it instead of expensing it like they should have.
So instead of listing it as like an equipment, which is probably where it should be, it's being listed as an inventory item because they count it. Inventory items would be like consumables. So in an HVAC situation, if it is like the insulation or, you know, some kind of cleaning supply or like some kind of solution that they would use, something like that, that would be considered inventory. The specialized wrench that they have to use to open up a certain thing, that's going to be, that's an equipment item and is an asset that's on, it's in a different section of the balance sheet.
Yeah, and I get that. It's just I think some of these businesses, they don't put like, it's not like inventory that would normally be sold to a customer. And sometimes when we're going through the whole process of when we're looking at a business and let's just say the broker comes back and they're like, well, we're gonna charge you for inventory in addition to the price. And I always make the argument that no, that's already included in the multiple that I'm paying you anyway. But on top of that, you're asking me to pay for something that's just consumed in the course of business, not necessarily inventory that's being sold to the customer. And so I think there's always like this, you have to kind of distinguish because you're not going to count that inventory like under one of these inventory valuation methods. I'm not going to count like if I'm a construction company, the screws that I'm using to put in plaster or whatever. I'm not, it's different than you know, like tile that I'm actually going to.
For instance, I'm working on a valuation right now for a commercial like tile and countertop company. So they don't actually carry any of the raw material, which would be considered their inventory for their business, on hand. So they don't order it until they've actually gotten paid for the client to actually order it. So, or the purchase order has been submitted and it's been approved, and then they'll go ahead and purchase it. So a tile or a countertop, that's going to be it. But any of the milling items that they need. So, you know, if there are certain sands or like I mentioned, like some kind of chemical or something like that to clean it before it goes out to the client to be installed, that is more of a cost of goods sold item, not an inventory item.
Yeah, that's the
supply to use. Yeah.
Exactly.
So, yeah, 100%, Rich. Whenever you're having an inventory conversation with a seller, is find out what are they considering inventory. But on the flip side of this is that I've actually done valuations of companies that are like auto repair shops that they carry a heavy amount of inventory. They carry air filters and oil filters and, you know, oil itself and, you know, bands and light bulbs for the, you know, the brake lights and the headlights and things like that. They keep all of that on hand so that they have those kind of upsells, right? Whenever they're doing your 10-minute oil change. But they don't actually count the inventory. And that would be an inventory item because they have it there for it to go onto a customer's vehicle.
Right. That makes sense.
So if they don't have that, that's also a red flag for me of why isn't that included? But the
Yeah.
inventory can also be a negotiation point. You know, to your point, under a market-based approach, yes, it's going to be included in the total cost. But if you're using an income-based approach, we're looking at cash flow plus inventory.
Mhm.
So it also, so their determination of, you know, when the broker says, well, you're going to pay me this plus the inventory, the question is then, okay, what was this? What is that number? What is that based on? What was the method that they arrived at? Because if they're doing X plus inventory, then they should have done a cash flow based or income based valuation plus inventory.
Yeah.
If it's a market based plus inventory, then yeah, then you got a negotiation standpoint, and yeah, you're going at them because it's not there.
Yeah.
And if they're doing asset plus inventory, run away quickly because the asset is the inventory.
Exactly. Right.
Just saying.
Brittany, can I ask a question quickly?
You
We have a
100%
lot of
can ask a
plumbing,
question.
companies. It would be common to keep a standard toilet or two in inventory, common faucets in inventory.
Okay.
Is that correct? Are they?
You're talking
are
to
they
a plumbing
fixed?
company?
Yeah.
So, all right. I'm going to use the example of a plumbing company that came out to my house whenever my sink was broken. Okay. Because it was leaking and we came out, and the sink that they had on their truck didn't fit. So is a whole toilet? No, that's not necessarily gonna be specific, because you could purchase a one, like for our house, like we have like the taller like handicap toilets that have the elongated. So, and I don't want a short one. Like if that breaks and someone's gonna replace it, I don't want to replace them with the shorter one that's, you know, you see in the public restroom, right? I want the same one that I had. You could carry that for too long as an asset of your business. So if it's a big item like a toilet that's going to be like a couple $100 inventory item, unless you know it's going to be used soon or it's a hot ticket item, that's not something you would necessarily want to keep. But if it is something that is a rotating, like it's the most popular sink or faucet that, you know, Kohler has one, and you know, you guys use that one, you know, out of the last 20 jobs, you've used it 10 times. Sure, keep a couple of this on there. So, you know, really, that's not necessarily industry standard. That becomes a evaluation of, and an evaluation, not evaluation, but an evaluation of your last, like, look at your last like 10 or I'm sorry, 20 or 50 transactions, and what were the items that were used. If you see a common thing between those, then sure, keep one or two on hand on the truck for it to be used. But like large ticket items like a toilet, that's not something like that I would do from a cash flow perspective. It's just as easy to go to Lowe's or Home Depot or, you know, whatever your supplier is and get that for the client and come back.
Thank you.
Because the client, honestly, for me, if my toilet's broke, I'm not expecting them to come in with another toilet. Honestly, I'm going to understand that they're going to have to look at it, go, and come back. That's just kind of something that most reasonable people, I'm going to clarify that, would expect to happen. Okay, answer your question, I hope.
Yeah,
Cool.
it does. I guess it depends if when the plumber goes off to the vendor, if he is paid for actually doing that, or if there's a markup on the toilet for doing that. Because otherwise you're better off keeping certain stuff, I think, around.
Yeah, then you're looking at pricing strategies. Like if that's the concern, I would take a deep dark look at the pricing strategies and what's being used. One of the things, so a little bit of background on me that wasn't in my profile is that we actually, when I say we, my dad's my business partner, we actually were business coaches before we were evaluators. So we actually did both at the same time. So in my coaching career, I encountered this a lot. Is that whenever we worked with home services based businesses, is that the technician did not do the sales. There was actually a salesperson that did the sales, and let the technician do the technician things. So because your tech knows how to fix or install whatever, but they don't necessarily understand pricing strategy. So like our preferred plumber, the technician will come out, do the assessment, call the office, have a conversation with them, then they will actually call and have a discussion with us as to what the pricing is. So that just kind of saves you on pricing strategy so that you're not losing money on the deal because the technician doesn't know what they're doing.
So you have a technician and you have a comfort advisor.
Yeah, exactly. So that's just one of those things to kind of help like stave off that issue, because we were working with an HVAC company at one time where it's a family-owned business. It was a dad, his son-in-law, and his son was the technician. And his son was an okay technician, and his son-in-law was a stellar salesperson. But the technician, like his son, did not like he could not accurately, like he would have given away the farm, honestly, because he just didn't know any better. So, and that's a lot of training and understanding for somebody to have to do both. So where you're looking at is more pricing strategy. So that kind of gets into more of an operations thing of seeing how you want to handle that from that perspective.
Thank you.
Sure thing. All right. So red flags on inventory. If there is an excess of inventory, it can be a signal of poor demand or it could be mismanaged. If you ask the seller, when was the last time you did an inventory count? And they go, that's a solid question. There might be a problem, okay? Because that's what happened with the seal in Beaumont. I asked the daughter-in-law, because she called me. She was so excited. She was like, I'm so glad I get to talk to you and da-da-da. She's like, you answered the phone. She was like, I have all these questions. And I'm like, okay, my first question was, when was the last time you did an inventory? She's like, probably 20 years ago. Okay, so we need an updated inventory count, because that'd be one of the things that I would probably request as a buyer is an inventory count, so that you know what's there, and you can verify what they're carrying on the balance sheet. And just kind of a operational thing for you guys, if you are getting into a perishable items situation, a weekly inventory count is preferred. In an auto parts or something like that, a once a month random check. So pick like 10 of your inventory items and go check, like spot check those. And then doing one annual inventory. If you're in-home services, HVAC, plumbing, something like that, an annual inventory is sufficient, right? So if you ask them and said, well, about this time last year, or it's been about 18 months, they're probably coming due for it. But if they've gone through a successful exit strategy, because I work both sides of the transaction. If they've done a successful exit strategy, they've done an inventory recently and can provide that. Sometimes you may see discrepancies between the records and the physical count, and then that can either be a decision for you of, is this a rabbit hole I want to go down, or is this a deal breaker? I have seen inventory break a deal before, so that's why this is important to the conversation. So I promised you guys something new. This is how to calculate inventory days, because theoretically inventory is supposed to be a short-term asset, right? You don't want to keep the inventory on the shelf for 18 months, because then it's either become, you know, out of date, or it's irrelevant, or it's moved on to the next thing, whatever it is. So this is actually one ratio that we calculate through our process of doing due diligence. We even do this in a full detail certified valuation situation, is calculating the inventory days. So now this is per the conversation or question that Rich had about 2 slides ago about the inventory being accurate. So this would be based on the actual usable things, right? So the faucets, you know, anything like that, any usable items. This is not equipment inventory, okay? So your inventory days is going to be inventory divided by cost of goods sold times 365. So the example I have for you guys here is the inventory. This is an actual calculation from a oil and gas company that we had. So their inventory was $424,484. This is based on their balance sheet, divided by their cost of goods sold, which was $29,191,845. So when we do that calculation, that leaves us with 0.0145. Then we're going to take that, we're going to multiply that times 365, and that gives us 5.37, which means their inventory is 5 days. Now, 5 days seems like a short amount of time, and it quite honestly is for a turnover. But if we're seeing something that's just 15, 20, 60, 90 days, and we don't know if that's considered a short-term asset for that business, or is it close to industry standard, then we actually need to go pull industry information and do a comparison. So that is part of what we do. Rich has actually experienced this process with us. A couple of years ago, we were looking at a business together. And so we actually will take a look at this versus the industry and tell you if it's in the top 20, bottom 20 for this particular ratio, as well as some others. but this is actually what happens. This is how you calculate if the inventory has been sitting there too long. So if you know if it's obsolete or not, this helps you figure that out, because they can tell you, well, our inventory's been on for this amount of days or this, that, or the other. This is the actual physical calculation to figure it out. So moving on to other assets. Other assets can be tangible assets, like we talked about: equipment, vehicles, real estate, intangibles or trademarks, patents, customer lists, goodwill. Love me some good goodwill. Contracts and agreements. So those can be leases, supplier agreements, employee contracts, etc. So, you know, when we talk a book of business, that is an other asset. Okay, that's what that would be under there. If you purchase the business from someone else, a lot of the time your CPA or accounting professional would consider it a goodwill. If you have any trademarks, or you created a like online class on how to install a toilet and you sell that, that would be considered a goodwill item that would need to be listed on your balance sheet. We actually have a valuation that we're waiting on right now that's the very thing, is their entire company or business is based on an online program, well, multiple online programs. And so we're having conversations with the CPA on how that needs to be calculated and assessed, and then ultimately be considered goodwill for the purchase of the business. So here's some tips to assessing those assets. Obtain professional appraisals for the significant tangible assets. That would be your buildings or any real estate. So find yourself a good commercial real estate appraiser. If you do not know one, contact a good commercial real estate agent in your area and ask who they recommend, because they're going to be working with them. They may tell you, oh, I can calculate that for you. Tell them, thanks, but I'd like to have an actual appraiser do it for you, so that you know. Any large equipment. So large equipment could be anything from a, I actually had this the other day, a crane to a forklift to anything like that. So in a smaller, like mom and pop HVAC or plumbing business, you might not have much large equipment. It would be more like a car or a truck or something like that. Might not necessarily get an appraisal of like an F-250, just kind of run with what they have there. But if you're dealing in like more commercial or industrial and they've got large equipment, you might want to try and get an appraisal for that to understand where it's at. For intangible assets that contribute to your revenue, those could be exclusive contracts. We see this a lot in government contracting for small businesses that support large contracts. Online courses, like I mentioned, or goodwill, which could be a purchase. Fun story for you guys. I actually had a valuation in Florida for a buyer. She was relocating from Maine to Florida because her husband had just purchased a pool company, but she was like, I owned a hotel in Maine. I don't know what I'm going to do in Florida. So she found a couple of coffee shops. And so we had helped her husband with the pool company. So she was like, can you help me with the coffee shops? Absolutely. We get into the financial statements and we see goodwill at $300,000. Well, the company was selling for $350,000. That was the sales or the asking price. Yes, but emphasis on asking. And so we were trying to figure out, so we saw this goodwill on there. We asked the seller, we're like, so we see this goodwill. And she was like, well, that's what I bought it for. Okay, cool. Understand that. But where did you get the $350,000? She was like, well, so $300,000 I paid and the $50,000 I put into it. So that's how I arrived at my number. I'm like, okay, cool. Not how valuation works, but awesome. So when you see goodwill, ask questions. Okay, what encompasses their goodwill? Because it can be a arbitrary number as to how someone arrived at it. But like we actually had one again in Florida. I'm in Texas, but I work all over, so a lot of my fun stories are in Florida. If there's any Florida people here, I love you. Was an in-home nursing care company. She was trying to develop a franchise concept and actually paid about $150,000 to have her book created to sell it. And it, yeah, she never had it listed on her balance sheet. So when I valued it, it was only worth about $7,000. And I was like, you have a $150,000 asset that's just like not here. So that's more for us on the seller side, but on the buyer side, ask questions to what the goodwill is. So for you guys, ask for the detailed asset, because theoretically the seller has gone through and had these done. And if they haven't, sometimes you can come to an agreement to where if you want it, you can either split the cost on having it done or something like that. I see that all the time with my valuations, is they'll split the fee. And then are there, as always ask if there's any encumbrances on the assets. An encumbrance would be like a lien or a lease. And if there are one of those things, 100% get a consultation from an attorney to find out what, you know, what's the situation behind it. They're going to be able to walk you down the garden path on figuring out what all that looks like if there is an encumbrance. So tips to investments. Ensure that the add back and assets are accurately reflected in the offer. Add backs can swing the valuation up or down. So have that conversation with your entire buyer team. How many add backs are too many add backs? That is 100% a you question, okay? We had a gentleman that was trying to purchase a company that repaired refrigerator doors in like restaurants and grocery stores. And so the seller sent him financial statements, and they also sent him an accompanying Excel spreadsheet. And so when he opened the Excel spreadsheet, it was all the add backs that they had to add back in the financial statements. Page 1 was all of their personal expenses. They read everything through this, from their groceries to their Netflix. Page 2 was that they owned a condo in Sarasota that they did a remodel of, that they let the company pay for. So page 2 was all of the construction add backs that they had. So for him, a 2-page Excel spreadsheet was too many add backs. Okay. So, and I kind of agreed with them. Could we have done it? Yes. Did we want to? If there's enough money, yes, we can. But, you know, it was, for him, that was a deal breaker. You know, and honestly, the recommendation to that seller was to go back and basically have their financial statements adjusted to go ahead and reflect those, or else they were never going to sell it. Do those inspections in the inventory. Verify the financial documents and valuation with an independent advisor. And don't rely solely on the seller provided figures. Verify through other sources, i.e. use an outside third party to render an opinion and help you with figuring all of these things out. So last thing that I have is just the key takeaways for the day. And if you guys missed Lynch, sorry, I put a Lemmy number or a picture up here. The add backs are going to provide a clearer picture of the cash flow, but they are going to require scrutiny. Just like I said, just because the owner says it is does not mean it's true. You do have the ability to make adjustments to their add backs. Inventory and asset valuations are integral, that they're accurate, and then just a strong due diligence is your best tool for negotiation, quite honestly. This final page is all of my contact information, my office number, my cell phone number, my email address, and our website. I will actually drop all this into the chat thing if I can figure out how to do that through Google. But Rich will tell you, if you call me, you text me, I'm gonna walk you through whatever it is that you need. I'm readily available on things. So we're here to help. So I know we did a lot of questions. I'm trying to get this thing to go away so I can see all your beautiful faces. What other questions do we have?
I have, just before everybody else kind of launches in.
Oh, Rich is jumping in on a question. I love it. He's
No,
ditching.
So you guys, when you guys do your valuations, you're establishing kind of fair values for all the assets, you know, the assets that you can, the tangible assets. You're trying to put some value on whatever intangible assets you can, but for the most part, could I take your evaluation essentially when you guys are done with it, because you do professional evaluations, so could I take that valuation and then basically do my purchase price allocation from your valuation? Or is it going to still be another like setup where I have to go to like a CPA or somebody to actually do it? I mean, and again, most of the people on here know me. I'm a CPA, but don't ask me tax questions. So don't, you know. I'm
yeah,
not a tax
no, 100%, zero on the tax question. Okay, I'm sorry, I was typing. Ask me. Okay, yes, I do valuations.
And can those valuations basically be used for purchase price allocation?
Yes, they can.
Okay.
Yes.
So I'm going to get a full range of values for all the major assets that are there.
Yes,
okay.
yes, 100%. So to Rich's thing is that, okay, we're a little bit different than most valuation houses, okay, is that we actually offer 2 different valuation products. So we have a calculation of value. So it's more based on an income based, and to kind of do more of that due diligence of, does this make sense to move forward? The second side of this is a full detail valuation, which is to Rich's point, that gives all of the different valuation methods. We've gone through, we've done the adjustments, we've done all the things, all the fantastical, that's there. Literally, if you walk into your negotiation with that detailed valuation, then there's going to be a lot less questions because number one, it's been done by an independent party. Number two, this is actually stands up to IRS, the court, the SBA, everybody and their brother, okay? If there are questions, we're here to answer them, but most of their questions will be answered through reading the report that's there. Literally, the way that we write it is you shouldn't have much question past page 5 because we pretty much front load most of what you need to know, but everything is there. Both of those reports end up being like 50, 60 pages worth of information, but they show different data. So our 360, which is our calculation program, is more performance. And does this make sense for you to move forward? The full detail is more on the valuation of, okay, we're getting into the nitty gritty. What do we need to know? The way that we operate as well is if you start off with the calculation program, just to see, does this make sense to move forward? And if you do, then we can come back and prorate to do the full, like the full details, to where we can get you like all of the answers. Okay, so that way you're not paying 2 fees. You end up paying 2 fees, but it's less. Like there's our calculation program is about half of what it costs to get a full detail. So it's a little bit more cost effective to do that way. I see Paul's question, the cost as far as the ballpark. It's based on the company. So the subject company's previous year's revenue. So on our calculation program, it's anywhere between like a 1,700 to like 8-ish thousand, plus. Our full details, they start at 4,000 and go up from there. So it really does depend on the company. And then, like I said, if you start with the calculation, like let's say that it's a $2 million company, my fee on that's 2,500. My fee on doing a full details 5,000. So we could start off with 2,500. If we get a month or two down the road, you're like, okay, I am going to move forward. Then the balance would be 2,500 to come back and prorate and then certify. So.
Perfect.
Awesome. Any other questions? Rich, I know that answered your question, but any other questions? Did you have any other questions, or can we open it up to the rest of the floor?
Oh, no, it's open. It's open.
I know he feels special, and he is special because
No.
But, so yeah, anybody else, like either drop it in the chat, come off the thing. I like to talk to everybody, so fire away. I'm ready.
I have a question. When is the right time to be having these conversations with the seller or the broker, like pre-LOI, during due diligence? When do you push back on the add backs? When does this whole thing take place?
So honestly, it's going to depend on when you got the financial statements from the seller. Okay, so if you were able to get financial statements pre-LOI, then you can start having these conversations now to understand their add backs. So if they've given you a prospectus and you're like, okay, this looks good, I want to see more, right? In that prospectus, they typically will list their add backs. Not every time, but sometimes. Again, depends on how prepared they are and like how successful of an exit strategy they've gone through. So if they are willing to provide that pre-LOI, great, you can start having that conversation then. If they're like, I'm not going to submit financial statements to you until I get an LOI, I have some attorney friends that makes their head explode. And they're like, no, we're not doing any kind of LOI because they think it's going to be legally binding. So it really just kind of what you can get. If you have to submit LOI to get the financial statements and then we're doing the assessment, then that's when we're going to have that conversation to do that assessment, right? So it really all kind of depends on when you get their list of add backs compared to the financial statements, doing that independent assessment. So it depends on the transaction. I've had some that it is pre-LOI. I've had some that it's post-LOI. I had one that got really down and dirty that they didn't want to do an LOI. They wanted a contract before they submitted, or they released.
Florida?
No, it was here.
Oh, it's always easy in Florida where they're always trying to bind you up with a. I
know, right? So so this was the thing on that one was that the SBDC sent me the client. So I started having the conversation with the client. He said, well, they're not going to give me anything without submitting a contract, so I want to submit a contract. And I'm like, okay, pump the brakes. No. Yeah. Sweet. So I called a bulldog attorney friend of mine and I said, hey, I got a client that they're needing to do some due diligence, but the seller wants a contract first. He said, I got you. So he wrote a contract that was so specific that the seller or the buyer could back out for any reason. I mean, it was almost so detailed that if he had wore the wrong color of pants to the meeting, he could back out of it if he wanted to. Like, it literally was for any reason whatsoever. It was beautiful from a contract perspective. So to answer your question, Eric, is, and I hate this answer, okay, is it depends. That's why I drew out the answer. So it really is, how is the seller and the broker working with you as far as getting you data?
That's the perfect answer, Brittany, because you'll see this all the time. All of you guys will see this all the time, where you'll get some brokers that are so good at what they do and they're so detailed in their approach that they'll try to approach the deal as if they are actually a true investment banker, and they'll have all the information right there, the ad backs, and they'll have a nice presentation. Then you'll get some brokers that just came over from real estate, and they're trying to bind you up with a contract, and they won't provide you any information. We'll submit an LOI and we'll give you more information. So the way around that, and Brittany kind of alluded to it, what that attorney did, the way around that is to write an LOI. And all you have to simply say is, this is subject to verification of the SDE and the ad backs. Price is subject to that. And then once you start getting all that information, then it becomes more subjective.
And if you guys want a referral to a fantastic attorney, I have like 5 of them that I just absolutely adore. I'm weird. I love attorneys. Like, they are my best friends.
Yeah, you are weird.
They like to go get queso with me at Mexican food restaurants. So I see Dana laughing at me really hard, and it's okay. Okay. I love them to pieces, but they're fantastic. Now, something else to understand about brokers as you guys do this, and Namdi, I see your hand is raised. I'm going to get to you, darling. Give me half a second. Is there are only 16 states in the U.S. that require licenses to be a business broker. So basically, if it starts with a C, they probably require a license to do so. So like Texas, we don't require a license. If you have a real estate license, you could sell it. I could sell a business if I wanted to. I don't. All you basically have to do is be a member of an association, have the right paperwork, and you're good to go. So trust but verify. And don't be afraid of the attorneys. Okay. I'm sorry, sweetie. I'm pronouncing your name. Nandi?
It's Namdi.
Namdi. Okay, Namdi. What can I do for you today, darling?
Just real quickly, you touched on it during your presentation, so I just wanted to ask you.
Sure.
So me and a partner, we own a automotive repair company. And so there's actually, just to make it real quick, there's actually another one available in the town where we own one.
That's exciting.
So they reached out to us to possibly buy it. Now the problem is that the company is not profitable.
Oh.
It's only not profitable because the person who owns it, he owns like 2 car dealerships, and he doesn't pay attention to it. But it's actually like really good location, and we believe we can use our knowledge to kind of turn it around.
Okay.
The question I'm asking you, because you touched on it a little bit, when it comes to like the valuation of the company, we're thinking about valuing it based upon the appraised value of like the hard assets in the facility. The lifts, the tire racks, diagnostic.
So you're talking an asset-based valuation. Yep, I got you.
So what I was basically asking is, like, does that make sense to you, or have you seen that before?
Okay, if you said the company is not profitable, okay, and I'm putting my CVA hat on, okay, as a evaluator, the only times I'm really going to lean towards using an asset-based valuation, which is what you're talking about, is if the company is less than 2 years old, okay, so it really hasn't had time to prove itself, or it has not been profitable for at least 1 or multiple years, because then I'm not using it, like my income approaches are out the window because it has no or low net income, so I can't really get there. Or the market approach, I could use a market approach, but because it's not profitable, it's hard to find a comparable, right? That's in the same performance realm. So then I would do an asset based. So my answer to you would be, I'd love to get a crack at the numbers, but if it's been not profitable for multiple years in a row, an asset-based valuation makes sense, especially if he's trying to unload it. He may just be looking for something that's like, okay, fine. You know, if he's reached out to you, he's probably willing to play some ball with you. But if you could actually come in with some like specifics, it helps. So yeah, no, if it's been not profitable for more than a year, yeah, I could see doing an asset-based valuation and that be your offer.
Yeah, if you've got no profit either, you're not gonna get.
Yeah, it's
generally,
real
you're not
hard
gonna
to
get
get
an
it if it's
you're
not
not
a
gonna
whole
get
lot
an
of profit.
SBA loan on it either. So you know.
Yeah, exactly. That's the other thing is that you could also have a little bit over a barrel for seller financing too.
Yep. I'd use liquidation value and then get a seller note on it, and that's how.
See, yeah, I get where you're coming from, Rich, but the only time I'm going to use liquidity value is if it's not going to be a going concern anymore or a buy-sell agreement tells me so. Okay, that's about the only time that I can go liquidity value. I'm just being real with you guys. I see what you're doing, Rich, and you're sneaky, and I love you for that. Okay, I do. I love it. So, did that help you, darling?
Yes, it sounds like the asset-based appraisal value is the right way to go.
Yeah, quite honestly, for where it's sitting at, but again, we could have a side conversation. If you'd like to take down my information, we can have a side conversation and kind of see what makes sense.
Okay, thank you.
Okay, sure. Chris Bassoni, I'm not sure. Is the E silent?
Depends where in the world you are, I guess. In Italy,
Okay.
it's Bassoni.
Okay, all right. So if it's Bassoni to you, it's Bassoni to me. So what can I do for you today?
So, quick question just about equipment being a fleet of vehicles.
Okay.
A seller is valuating his company at 2.3 SDE. Is that equipment built into the price? And then when we're, I guess, looking at the value of it as a buyer, do we remove those assets from our equation as far as a multiple is concerned?
I'm gonna let you answer this before I jump in with my.
Rich is super excited right now, y'all.
This
Okay.
question always gets me like heated up when I. Okay, go ahead.
I love doing these calls. Anytime Acquira calls, I answer because I love doing it. Doug's fantastic, but Rich, you're igniting my soul, and I love it. Okay, so Chris, to answer your question, if it's a multiple, it puts you in a market-based approach, which means that the assets are included. Okay, in that. So there you go. So your second part of your question is, do you remove it from your total?
Yeah. So like if I'm trying to put a value on it, right, we have the multiples that Acquira gives us, right?
Okay.
And so if Acquira is saying, yeah, the multiple should be 1.5 for that business, it's okay. I can run the multiple of EBITDA or SDE at the Acquira's recommended multiple, and then would I add the actual value of the assets on top of that? Let's say it's 100,000.
It's included because it's a market-based approach. So market-based approach is based on SDE so if it's SDE or EBITDA, sometimes it's net sales, sometimes it's honestly, the fact that you're telling me that there's multiples for the income stream, just make sure your multiple matches your income stream, or else you really kind of. I can't use that analogy. You're not doing it appropriately. So I get my butt in trouble if that doesn't happen. So if it's like a 2.5 times SDE and that's what it is, the assets included in that, and that's your market-based approach, you're in, that's it. That's that. You're done, that's it. If you're looking to do something that is more of a negotiation in the asset, I would get an income-based approach. Let's add in the inventory, and then you have a little which would be that fleet, so that hard fixed asset. No, actually, I'm sorry, it's even included there. So forget that question also. So yeah, no, you're not taking the assets out. It's already there.
Okay.
I won't even say anything, Brittany, because you answered it perfectly, and I don't have to blow my stack, because I cannot stand when I come across a broker who says, "Oh yeah, well, we want 3 times our 3 times SDE on this, and then we're going to sell you the inventory separately, and then we also, the market value of the equipment is blank." I'm just like, whatever, bro. This is I'm buying a collection of assets. Those assets created that stream. If I pay you for the assets and the stream, then I'm basically, you're double dipping.
You're double dipping. You are double dipping.
Yeah.
So I would see, okay, if they have all of that, they're showing it to you, it's more proof that they've done their due diligence and that it's good to go, but it's not going to enter in as part of the negotiation of pulling something out, right? You're not going to it's not a separate asset because it's already included. I saw somebody else popped up and raised their hand, but it went away already. So.
All right, we're at the end anyway. But Brittany, you're awesome as usual. Thank you.
That.
Thank you. If you guys have any questions, Brittany did include her information in the chat.
Absolutely.
Feel free to reach out to her directly. I know you'll probably hear from me, Brittany, because I'm about to sell my business. So,
I'm so excited. I love working on
so
exits. Awesome. Oh, wow. 2 years later, we're going to work again. I'm so excited. But yeah, well, thank you, Rich, Acquira, everybody, for having me back. Again, anybody, you have questions, give me a call. I don't charge for my consultation. So if you have questions, let's have chats. I love talking valuation, obviously. So.
Right. Well, thank you guys. Thanks, guys, for jumping on. Thanks for being here, Dana. And
well done, guys. Very well done.
Thank you.
Thank you, Brittany.
Thank you, Dana. I love watching you laugh at me. It just made my day.
You're definitely more entertaining than I am.
Oh, I appreciate that. I got to do something since I can't dance. All I do is talk. So I gotta make it interesting. So.
All right, Brittany.
Thanks so much, guys. Appreciate you all.
All right. Talk to you soon.